Thanks for clicking! Canada could be sitting on one of the biggest housing bubbles of all time. This according to yesterday's interview with MRB strategist Phillip Colmar. For his part, Colmar made widespread headlines last week when he called Canada's housing market the biggest bubble of all time, but has since doubled down on his predictions during a CTV interview yesterday. And the news comes as we're seeing multiple preliminary reports showing that the resurgent housing market that we saw during the spring is receding rapidly, with a major increase in inventory, and RBC saying that Toronto is rapidly moving back to a buyer's market.
Come crawling back, eh?
As such, I think it's worth looking at Colmar's interview where he said that Canada could be in for an imminent housing correction, looking at what Colmar says it would take to make house prices burst. So what I want to do today is go over Colmar's interview, taking a look at how he says Canada got to have one of the biggest housing bubbles of all time, how he says that bubble will pop, and then take a look at what to look for next. Speaking of next, it is the end of the month and the local real estate board should start releasing August real estate data over the next couple of days, and that data will give us a much better idea of where the real estate market is heading amid higher interest rates. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the interview. Colmar starts the interview with CTV News by going over how Canada's house prices rose so high so fast.
Particularly even before the pandemic, last decade, it had a cheap interest rate environment or low interest rate environment owing to really problems south of the border.
Indeed, even though Canada did not experience the massive economic downturn and housing crisis as the United States did in 2008, when the Fed lowered interest rates, the Bank of Canada followed suit. However, the key difference during the post-2008 decade is that while U.S. consumers underwent a deleveraging, getting rid of debt, Canadian consumers ramped it up, now owing $1.87 for every dollar of disposable income, compared to $1.01 on the U.S. side. And Colmar says that Canadians were drawn in by the lower cost of borrowing and piled into real estate post-2008.
And that seduced a lot of home buyers into buying homes at using those interest rates to effectively buy homes, and house prices to incomes surged.
And I think that's a really good point coming from Colmar. While we often attribute Canada's massive house price growth to the 0% interest rates that we saw during the pandemic,
the jury's still out on that.
Really, we've been seeing major growth in Canada's house prices since 2008, with the advent of near zero rates back then, with Canada's house prices hovering around $300,000 at the beginning of 2008 and reaching $500,000 by 2019. That's a $200,000 increase in Canada's house prices in just over 11 years. Whereas it took Toronto almost 20 years to reach a $200,000 price appreciation. And then, of course, as we're all aware, after a brief increase in rates in 2019, we had near zero rates during the pandemic and house prices skyrocketed. So we have near zero rates emanating from the United States, pushing up debt levels and house prices for almost 15 years.
I have a BMW.
And Colmar says that the real risk to Canada's housing market now lies both in the house prices and also the elevated debt levels of Canadians.
Certainly underneath the surface, when you're looking at a housing bubble, the things you really do worry about is when you not only have excessive home prices, but excessive leverage backing the whole system. And Canada kind of is really off the charts on that front. And that's really where the concern comes in, is on the leverage to income ratios is way north of where the U.S. was at its peak. Makes the U.S. look somewhat prudent, actually.
And yeah, this is backed up by a lot of the data that we've seen released this year, showing that Canadian consumers now have the highest household debt levels in the G7. And the only way out of this, absent a burst in home prices, according to Colmar, is for incomes to rise faster than debt levels, for incomes to rise faster than home prices.
When you're dealing with these kind of excesses, you're really hoping that home prices stay capped while incomes kind of grow for a long period of time and hopefully interest rates don't rise. That's a hard thing for policymakers to orchestrate.
And that's definitely a tall order, especially with the Bank of Canada being adamant that an increase in wages could lead to higher inflation, which could lead to higher interest rates.
I'm gonna get you.
If higher wages are going to lead to higher interest rates, then it's very unlikely that we have the time for wages to rise faster than debt levels. As such, Colmar says that if or when the recession hits, or we see another increase in interest rates, we could have major downward pressure put on Canada's real estate prices.
The things you'd want to look at, I wouldn't say it's necessarily imminent, but the things you do want to look at is if mortgage rates are going to rise again or unemployment starts to rise. Those are the things that really bring it home to roost.
Which makes sense. Demand decreases when people can't buy houses due to unemployment or an increase in the cost of borrowing. And, unfortunately, supply increases when people can't afford the houses that they already have. But when will this all unfold? What is the timeline for this correction? Colmar says the correction is largely dependent on what happens in the United States.
U.S. rates are in some way, shape, or form tied to United States rates. And so when people unwound their recession bets or their imminent recession bets, we started to see new highs in the 10-year Treasury south of the border. But it drove up mortgage rates here, or bond yields here, which drove up mortgage rates here. And that's the risk point. So that brought it home to roost, where if that keeps going, then look for a very near-term bursting, so to speak, of the bubble.
And we talked about this a few videos ago. Although U.S. yields are down this week, they're down from last week's 16-year high. There's still a lot of upward pressure being put on U.S. Treasury yields. And as Treasury yields remain elevated, upward pressure is put on Canadian bond yields, which puts upward pressure on fixed mortgage rates. But, says Colmar, if U.S. yields subside, if we don't see any major upward pressure on interest rates, then the major housing correction could be about a year away, when the recession hits.
Otherwise, we're looking towards a recession. That's probably, you might get another year out of it, but then we're looking into the next recession. And of course, Canada, although I think the U.S. would go through a mild recession, given its household sector is in good shape after going through a bust and deleveraging, Canada is going to face sort of what the U.S. did, a very deep deleveraging cycle, quite a pronounced recession.
So, all in all, Colmar is saying because Canadians are in so much consumer debt, because house prices have risen so high, if and when a recession hits, or if and when interest rates go even higher, we could see a major correction in house prices. And Colmar isn't the only one preparing for or warning of a potential major decrease in house prices, as it came out this week that Canada's big banks are setting aside billions in loan loss reserves. And I think this all makes sense. There's a direct relationship between someone's ability to afford something and its price. Housing, in and of itself, is valuable, although it's not clear that it's over 100% valuable than it was 15 years ago. Housing is only worth what someone is willing or able to pay. And with cracks already starting to show up in the Canadian economy, and the central banks making it quite clear that rates are going to stay higher for longer, it's not clear that Canadians have the income or the demand to sustain 0% house prices at 5%, 6% rates. With that said, I think we're going to have a much better idea of where Canada's house prices are heading when we get the release of August real estate data. The real estate data which will include much, much more elevated interest rates. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.